Marten Hoekstra, EGShares recently launched its Emerging Markets Core ex-China ETF. It's the XCEM as the ticker. So is this a call on all the volatility we've been seeing in the Chinese markets recently, or just very timely?
Now, China's on people's minds. That's not the reason for the fund, but you know what has been driving things is the introduction of A-shares in the big indices. For the last couple of years, Americans have been able to invest in them for the first time, and they're a bit more volatile than the Chinese shares we used to be able to own. And obviously, in the last couple of months, they've fallen out of bed. On the other hand, we registered the fund prior to that time, and basically it was to make sure that people who wanted to control their China concentration could.
All right, let's talk about the XCEM. How was it constructed? There's a lot in South Korea.
Yeah, once you pull China out of the indices, South Korea becomes very important. It ends up being sort of 18–19% of the index. Brazil's always going to be a big holding. You're going to have maybe 10% in India and South Africa. And of course, Taiwan pops up. So you just end up with a little bit different look.
Well, how much does China affect these other emerging markets? Clearly, it weighs heavily on the surrounding countries, in Asia, but it also has a big pull on Brazil, as we've seen, because of all the iron ore and commodities they ship there.
Yeah, absolutely. China is a big demander of commodities globally, and as demand has slackened, that has affected commodity prices across the board, and obviously it's had an effect on currencies too. At the same time, the reality is that the indices, the big indices that a lot of funds track, whether actively or passively, are sort of going from the mid-20s in terms of their concentration of the percentage of the portfolio in China to something over 40% in the next 2 years, according to the index providers. And so you just find a lot of investors who say, I understand China's really important, I understand it drives a lot of things, but maybe I either don't want to own that much or I want to control the way I own that much.
What's interesting about your ETF is that it owns a lot of financials and IT. One would think the XCEM would have a lot of commodity stocks in it, but that's not really the case.
Yeah, what happens is just emerging markets in general, as they develop, they build out banks first. And so financials, it sounds like it's a lot, but it is actually almost no insurance companies, almost no asset managers. It's a lot of banks.
All right, and then finally, how will higher interest rates here affect the emerging markets? Because for a long time, the thought was, when we raise rates here, it hits, emerging markets the hardest.
Yeah. That's a rough one to generalize, but in reality, the effect is short-term. In fact, long run, it may be a competitive edge for emerging markets. Remember, they have a really different situation than the U.S. A lot of them are running surpluses in their budgets. A lot of them essentially have no trouble financing themselves, have a better balance sheet than the United States, and most importantly, a few of them have high real interest rates, meaning they actually have the power to cut rates, something we can't do. So long run, monetary stimulus is actually more possible in a lot of emerging markets than it is here.
All right, well, thanks a lot, Marten.
Great talking to you, Greg.
Thank you for watching The Street.